Hey, welcome to the latest edition of The Everyday Investor. I'm your host, Darcy Angaro. Today, we're talking commercial investment property. What's the deal with commercial investment property? Well, it's quite a different deal to residential investment property. And if you're thinking, right, I need to get a better return, I need to get more cash flow from an investment with less fiddling around, then commercial investment property may be for you. Higher barriers to entry, but greater rewards potentially. So keep watching. We have Jack and Brandon from Newland Burling sharing with us on the show today. Hope you enjoy. Now, before I let you go, I want to plug this magazine right here, Juno Investing Magazine. I feature on it this edition on page 60. And so I just want to do a quick shout out for Juno Investing Magazine. Thank you for putting me on there. If you want to subscribe to that magazine, check out junoinvesting.co.nz. Otherwise, hope you enjoy the show. Hey, welcome to the NZ Everyday Investor. I'm Darcy Angaro, and I'm joined in the studio by Jack Revel, JR. Welcome, Jack.
Thank you.
And Brandon Wilcox. Welcome, BW. Is that what they call you?
Not really, but it'll do.
Not really? We just started a thing. Okay, so today we are talking about commercial property. So can you just start off by telling me who you guys are and how you fit into the scheme of things?
I can cover that bit off.
Yeah.
So we're both from Newland Burling, and we also have a sister company, Provincia Property Fund. Newland Burling basically works with investors. We teach people how to invest in commercial property. So we specialise in commercial property, teach them how to invest in commercial property, then we will help them buy commercial property. We have a property finding service where we'll actually go out, find the properties, do the due diligence, negotiate the sale and purchase with them. Yeah. And we have a property management arm, so we manage commercial properties just like residential property managers, except with commercial property the tenant pays for the management, not the landlord.
That's right. Okay, and we'll chew into that later on because I want to drill down into the key differences. And Jack, what's your role with Newland Burling?
So I'm the general manager at Newland Burling. So I oversee the management team, which is my main role. And then on top of that, I do a lot of the property finding and due diligence. So that's looking at clients' deals, helping them do the deals, making sure, looking for the pitfalls. Is it a good deal? Is it a bad deal? The positives, negatives. Yeah. And then also with the fund, I'm the asset manager. Okay. So I'm managing the commercial assets that the fund has, and then also the acquisitions. So that's looking for new deals, new properties to put into the fund that will fit, and then also carrying out the due diligence on those properties.
Sweet. And for context, the reason why I reached out to you guys, maybe because of your fearless leader, Ollie Newland. He's a bit of a brand in this space.
Yeah.
And I was trying to figure out, well, who are some of the guests that I could get on the show to talk about commercial property? I've had quite a few listeners that have piped up over the last 12 months, especially just saying, you've covered all these topics, but you've left out something. What about commercial property? What's the deal with that? And so I wanted to reach out to somebody, and you guys seem like you know what you're doing, so why not have a conversation? And I want to just really break it apart a little bit. What's the difference between commercial property and residential property in terms of, from an investment perspective?
Yeah.
But then also, what are some of the pitfalls? What are some of the mistakes to make? And to frame all this, let's start maybe with the problem. The problem is that it's hard to get a return on investment these days with declining interest rates. So because of that problem, people are starting to look outside of what they've normally looked at in the past.
Yeah.
How does commercial property fit into that as a potential solution?
Well, it's an interesting one. Most commercial property investors come from a residential background. And the founders of Newland Burling, which is Carl Burling and Ollie Newland, they're no different. And so they typify what's happening with commercial property and residential property. With residential in particular, yields are going down and down and down. So you might be getting 3-4% yield, but you've got to pay all your costs off that. So take another 2% off. A lot of investors are really breaking even. And so they're providing a space for tenants to inhabit free of charge, and the only thing that keeps them going is the knowledge that one day there's going to be a capital gain. If it wasn't for that, they just wouldn't be in the business. And so with commercial property, typically they're net leases, which means the tenant pays for all the outgoings, and the yields are higher, and so you don't have that 2% discount for all the outgoings.
Chase for yield.
Yeah.
The hunt for yield, and thinking about it as a as I guess like a migration, the diaspora of residential property investors that have fled.
Yep.
And now they're jumping into commercial. That has an impact as well, right? Because I suspect more demand in that space, that pushes up prices in some bands.
Yeah.
But would you say that a lot of residential property investors who are entering into this space might come into the space initially with a lens still of residential and they don't quite get it?
Absolutely, yeah.
Okay.
I mean, if you come from a residential property investing background and you're investing into commercial property, you sort of see them as exactly the same thing, just bigger numbers and scarier.
Yeah.
But they're completely different.
Yeah.
Absolutely completely different.
Okay.
Jack will talk more about that in a sec, but just going back to the chasing the yield, there's two things happening. One is residential property investors exiting the residential market and investing into commercial, partly for yield and partly because of the politicisation of residential property investing, the demonisation of landlords.
That's right.
And so because of the stigma and just the difficult political environment, they're exiting. There ain't no politics in commercial.
Yeah.
I mean,
Not yet. Now that you said that, there will be, right?
I think, socialist governments don't see it as a problem where you've got business people dealing with business people. They're all the same class of evil.
They can do whatever the hell they want to each other.
Exactly.
Who cares? But just don't. Yeah, and I guess that kind of makes sense as well, right? Because we do have a duty of care to make sure that we're protecting those that are a little bit more vulnerable and those who aren't financially able to own their own home.
Correct.
So that totally does make sense to a certain degree. But if you're trying to look at this from an investor's perspective, somebody who's taking significant risk, they're putting themselves out there to do it.
Yeah.
When things get really, really hard, they start to ask the question, well, why bother? And it is still a free market last time I checked. So people will just leave that. And there's going to be negative consequences as a result of that.
There already are.
Absolutely.
Yeah.
Totally.
Well, rents in Wellington went up 13% last year. And as the supply of residential investment property dries up, it's good for first home buyers, but smaller number of people occupy a first home buyer's home than occupy a rental home. So
Do you want to break that down a little bit?
Okay, so typically two people will buy first home buyers. That's a couple, so two people. They might be moving out of a flat that has 4 or 5 people in it. So 2 people get the house. There's another 3 people left behind wanting to rent somewhere. So some people think, but it's okay. It's net even. One rental house comes off the market, but one first home buyer comes on the market.
I see what you're saying.
But it's not that simple.
Because less people occupy owner-occupied homes compared to rental properties in general.
Yep.
I see. So you're releasing way more people into the wild who want to buy these properties, and you're releasing way more tenants into the wild.
Yeah, or displacing would be a better word. You're displacing tenants into the wild. They're competing for a smaller number of renters, and so that's why rents are going up.
Yeah, wow. Okay.
And all that's going to happen is that government will have to start providing more social housing.
Gotcha.
Which means taxes have got to stay high to fund the purchase of all this public housing.
Gotcha. Okay. And that is what it is, right? Like as soon as you make a rule, you have to create 3 other rules, and then create a committee to monitor those rules.
I call it the law of unintended consequences.
Yeah,
always happens.
Or negative spillovers.
Yes. So that's one side of it. The other side of it is investors who, if you think of a retiree who's got a lump sum on term deposit, as interest rates have come down, they might be getting, if they're on 12 months at the moment, they might be getting 2.6%. And
after inflation, it's almost zero.
Yeah, exactly. Yeah. I mean, you could have $1 million on term deposit, and if you're just relying on the pension and the interest off that $1 million term deposit, that $1 million is giving you 21 grand a year after tax.
Yeah.
It's a pittance.
Yeah.
So those people are also chasing higher yields. They want somewhere where they can park their money, somewhere that's safe, but something that's going to give them a much better return than 2.6%.
And residential property for those types of people might be a real big turnoff, especially at the age and stage that they're at.
No, they'd be getting less than 2.6%.
Yeah. And all the headaches associated with it, which they don't want.
No,
they just want simple, safe, reliable cash flow.
Yep.
Right.
Correct.
And enter into the equation commercial property.
Yeah.
So Jack, do you want to just take me through, what is the deal with commercial property? Like, what's the main benefits?
Yeah, absolutely. The main benefit in it is that high yield, and also you're creating value from the lease. So with commercial property, a lot of it revolves around the lease, as opposed to residential, where it's the market and the area it's in, and the physical aspects of the property. You add a new bedroom, you put your rent up. You tidy up the bathroom, you tidy up the kitchen, it adds value, and it might look more attractive, so you might get better tenants, or you might sell it for more.
Right.
But with commercial property, it's all about the lease.
Right.
So if you've got a weak lease with short-term leases, not under-rented, not favourable rent reviews, then that's lower value commercial property. But if you can strengthen that lease,
Yes.
longer term, better tenant, better rent reviews, higher rent, it's all about that lease documentation, and that's how you influence the value of commercial property.
Right.
And that's the
Such a
main
key difference. Yeah.
Yeah, it's huge. But if you can get your head around understanding the leases,
Yeah.
and understanding how the commercial property works, which is based on the leases,
Yes.
and the tenant security, then you can add a lot more value,
Right.
simply by changing a lease.
So 2 options here. I'm buying a residential property. I'm adding a bedroom, sprucing it up, and my whole goal is to increase the rent, but I'm only going to do it so much because I'm going to be driven by the market.
Yep.
Whereas I could buy a commercial property, and instead of actually looking at the building, I could do that as well, but instead of just doing that, I could actually get really forensic on this lease document and figure out
Exactly.
what opportunities are there to increase the lease terms,
Absolutely. Yep.
which then increases the value because you're buying cash flow.
Exactly. And then all you got to do is negotiate that with the tenant, as long as the tenant agrees, sign the new lease, and you've added lots of value to
Right.
the property, or even cash flow.
Okay.
And you've increased that return.
Because the lease will determine the value of the property, can you just break down the dynamics of how cash flow influences the value of that commercial property?
Yep, absolutely. So with the cash flow of the property, if let's just say that a property is under rented, you could paying $85 a square metre because it's been tied into consumer price index, for example, so CPI rent reviews. So it's on a historic rental of $85 a square metre. Market rent should be $125 a square metre, for argument's sake.
Okay.
So you might have the tenant leave. It's in a really good area. You might have a new tenant, especially if you're dealing with industrial properties.
Yeah.
Really easy in the industrial precincts to get new tenants. New tenant comes in at the higher rent, so at $125 a square metre. That new cash flow on a brand new 3-year lease will be, that's how you've just added your value in
Right.
terms of the new amount of a rental you're getting
Right.
based on the increase and
Okay.
that tenant.
Okay. What does the cap rate mean? Break that definition, because I know that you probably
Yep.
could have mentioned it just there,
Yep.
but you didn't. So you were thinking it. So tell us, what does a cap rate
So
mean?
cap rate is your capitalisation rate. So that takes into account the risk in the different areas, and the vacancy and the strength of the lease,
Okay.
strength of the tenant. So that's applying the cap rate to the type of building versus the lease versus the tenant versus the vacancy in the area, and a value will apply that cap rate, or you will apply that cap rate to say, okay, well, this is the rough value of the building.
Right. So if I wanted a cap rate of what would be a typical 6%?
Around
7%?
Auckland, yep, absolutely, 6%.
Yep. And I had a look at the lease. I was able to somehow modify that lease and
Yep.
make it more favorable.
Yep.
And then I would then reverse engineer what the value should be based on the cap rate that is correct in that area. Is that how it would
Yep,
work?
that is exactly it. Yep.
Right.
Give you an example.
Yeah.
If you have a building that's got a $100,000 a year lease, and it has it's a high risk building, might be on a month by month lease, so they're not on a long term lease. Other factors. So just to round the numbers off for sake of argument, somebody might say it's got a 10% cap rate. So to accommodate the compensate for the risks, I want a 10% return. Therefore, the building's worth $1 million.
Right.
You get the tenant on a 10-year lease.
Yeah.
Somebody might then say, well, I'm prepared to accept a 5% return on that because it's a really good tenant, it's long term, I know my money's secure. Suddenly the building's worth $2 million.
Yes. Gotcha. And also you could then, going a step further, if there were some other risks associated with that commercial property, like maybe there was some earthquake risk or something like that, if you could easily deal to that, then the cap rate that someone would require would go even lower, which then bumps up the value even more, right?
Yeah, that's another way to add value to commercial property as well. So they talk about the earthquake rating of a building.
Yeah,
so
take us through that. Like, what does that mean?
So they base it on a percentage of new build standards, so MBS, and that gives you a percentage. So basically, if your building is under 67% MBS, that's deemed, essentially earthquake prone.
So that means that your your building is up to 67% of the building
MBS,
standard.
Yep. So if you're below that, the banks want to know what can be done to bring it up to 67.
Sure.
If you're below 33, then that is considered earthquake prone. Sure. So if you're below 33, you've got to have a plan within 10 years to bring it up to that 67% mark.
Anything below 33 is earthquake prone. Anything below, much below, it's probably even wind prone as well, right?
Could be.
You probably want to be pretty careful, right?
Yeah, absolutely. But there's a few examples we've come across. There's one that we had in East Tamaki in our property fund, and that had a MBS rating of 30%.
Sure.
The reason for that is the previous vendor, one of the previous vendors in the past, had cut and roller doors down the side of the premises.
Sure.
And when they cut those roller doors in, they removed the steel bracing, the steel cross bracing that was behind those roller doors.
Right, okay.
Which brought the earthquake rating down to 30%.
Gotcha.
So it's a pretty simple fix on a $6 million building. So this is one of the big buildings we have in our property fund.
Yeah.
All we had to do was get reinforce the other walls with cross bracing. So it's just steel work, welding work, engineering designs. Total cost $40,000 on a $6 million building, and it brought the earthquake rating up from 30% to 100%.
Is that right?
Yeah.
And then obviously the cap rate that you'd require for that drops considerably.
Absolutely.
And as a result, the value goes up.
Yep.
Almost exponentially.
Exactly.
It's a significant.
Yeah.
Wow.
And you can do that on smaller buildings too. So smaller warehouses, smaller retail shops. It's just quantifying what has to be done to bring that MBS rating up.
So it's such a different headspace to be in, though, isn't it?
Yeah.
Like you really have to kind of almost throw away what you know about residential and jump into this and look at commercial for what it is rather than what you think it is. Yep. That's a significant thing. Just looking at the different ways that you can increase those lease terms qualitatively and quantitatively.
Yep.
That has a significant impact on the value. That's interesting.
Yeah.
It's one of the big things we focus on in our commercial property masterclass, because if you try and jump into commercial without good advice, it's really high risk.
Okay. Well, this is a good time then to tell me about the commercial property masterclass.
Right.
You spoiled it, man. I was going to build up to it, but you just dropped it. So tell us, because this is really important, and I want to stress to people that are listening or watching that with anything to do with any sort of investment, education is important. You don't want to kind of get stuck into the vortex of education because you'll never make a decision eventually. But some of it is really important before you just jump into this, because it's not what you know. Look at it for what it is. Yep. And often with stuff like this, there's usually a sales pitch just hiding behind the door, right? And so what I like about what you guys do is that it is education for what it is, to help people. There's no hidden agenda. People pay for it. Correct me if I'm wrong?
Yep.
So tell me about how it works.
Okay. So $3,770 plus GST. Yep. So it's not a big sum. Yep. We don't run free seminars to try and get people in and then spruik them on something else on the back end of it. It's all up front. And we teach them absolutely everything we can about commercial property investment. We start off with the really boring stuff, running through lease documents, agreement to lease documents, and just teaching people about the clauses, what they mean, what to look out for, because half the commercial property that you buy will have an existing lease in place, so you need to understand the lease. That's where the money is.
Right, okay.
Then we'll teach them about a lot of other aspects, tax, earthquake, what else, Jack?
Compliance.
Compliance,
that's a big one.
Yeah.
Do you cover the lending, how lending works?
Yep. We do. Yep. And then we cover off the due diligence process, so the steps that we go through when we're analysing buildings, and the multi-layered steps. So we start off with a coarse filter, very quick analysis, like rule of thumb, medium filter, where we're getting into more detail, and then fine filter. And we only go through the fine filter analysis once we've got it under contract.
Good.
And
that's good.
And then once people have been through the commercial property masterclass, that's basically 50% of the learning. The next 50% happens when you're going through the process of looking for your properties and analysing your properties. So there are three ways you can go. One is do it yourself. So some people go through the course, they've learnt enough, they're confident enough to do it on their own, they're off in the wild buying their own properties. Then there's done with you. So we have a done with you service where people can retain us on a monthly basis and we will help them with analysing the properties. We'll review all the documentation. We'll help them with the due diligence and basically protect them from making mistakes.
Right.
And then there's the done for you, where people go through the full course and decide, I don't want to do this.
Right.
I'll pay you guys to do it for me.
Yeah. Yeah.
And so they pay us to find the property, do the due diligence, negotiate the sale and purchase. And
Yes.
generally the high net worth people who for whom time is more valuable than money, so they'd rather pay somebody else rather than spend the time on it.
Right.
So it just depends on the
On who
individual
they are.
investor and what
So
they're looking
DIY, done with you, and then done for you.
Correct.
The three different options.
for. Yep.
Okay.
Yeah.
This is good. I'm picking up what you're putting down. Do a lot of people that get into commercial property investment, especially for the first time, because I'm not so concerned about those that already have. It's more those that are trying to develop. So people that are potentially buying commercial property for the first time, if they don't have this level of understanding, how do they normally do it?
A lot of the time they'll use their solicitor. I mean, that costs money. And if the solicitor knows their stuff about commercial property, that helps a lot. But if they don't, we see a lot of people making mistakes because the solicitor's checking all the legal documentation, but they're not checking the deal. What's the vacancy rate like in the area? What's the upside in the property? What's the negatives in the property? Is there potential for growth, rental growth, equity growth? Can we renegotiate that lease?
Right.
So it's checking all those little items. I'm not saying that everyone doesn't understand that. It's just one of the most common mistakes is people rely on their solicitor's advice, which is great from a legal point of view based on the lease and the sale and purchase,
Not a commercial
but not a commercial point of view.
And I guess that's the difference, right? You might be dealing with a solicitor who is awesome in one area, but other areas like commercial property, you might be paying for their education and not necessarily getting a good outcome. And they may or may not tell you up front that this isn't their gig, right? Like they might think that they're pretty good, but they might not be. Who knows, right?
Yeah.
Exactly.
Whereas this is what you guys do all the time.
Yep.
You're
Absolutely.
in this. Yeah.
In fact, last night we were talking about what lawyers will often do when they're advising a landlord getting a new lease in place. They'll advise them to put it on CPI rent reviews because it's easy, they understand it. It's the worst possible thing from an investor's point of view because then you're just locked into whatever the CPI is.
Sure.
And CPI is less than the real rate of inflation.
That's right. That's right. Yeah.
And
you
so,
just bound yourself to a metric which is just going to screw you over time.
Yep.
Yeah.
Yep. We bought one property for the fund where one of the tenants was on a CPI increase. And it's the numbers Jack was talking about earlier. They were paying 85 a square metre and the market rate was 120. Wow. And so that's what happens on CPI. The tenant falls further and further behind market rent. Great for the tenant, terrible for the landlord.
Sure.
Yeah.
Right.
So that's an example of the sort of commercial aspect that we will analyse things from and protect landlords from.
Gotcha. And if you're listening right now, you're thinking, well, commercial property is sounds awesome, but it sounds also kind of tricky. It is, but it's not something to be too scared of, right? There's still some gold here, right?
Oh, there's massive upside. Yeah. So in Auckland, it's the lowest vacancy rates. That are occurring right now.
Sure.
Right now, so you've got some really good upside, low vacancy, so that reduces the risk, and especially the types of commercial property.
So tell me about the types of commercial properties.
So there's three main areas in commercial property. You've got your retail, you've got your offices, and you've got your industrial. We like the industrial the most because it's got the lowest vacancy, and you've got very tightly held, especially in Auckland and Hamilton, you've got very tightly held industrial precincts. So there's a limited supply of an industrial land, and that's helping keep that vacancy rate very low. And on top of that, you've got a growing trend to third-party logistics, 3PL, which is...
so give me an example of that.
So that's basically like storage and distribution. So they're using warehouses to store other people's goods, and people pay for that use, and then they distribute from that warehouse.
Right.
And that's a growing trend.
Right.
So warehousing multiple companies' products.
Right.
Yeah.
Okay. This is like what you do with drop shipping and stuff like that.
Very similar.
Gotcha. Okay.
And one of the big things about industrial tenants is they survive downturns much more effectively than office or retail tenants.
Correct.
So the risk is lower.
I understand. Okay.
So with the trend in e-commerce, it's benefiting industrial, and it's reducing
it's hurting retail.
It's hurting retail, and it's hurting offices as well.
Sure.
So
interesting. Okay. And so if I was looking to get into this, and I was exiting residential property investment in the process. What are some of the ways that often it is done? Like, I'm thinking specifically about some of the lending requirements.
Yep.
How does one make that transition? How do you normally see this happening?
So there's two ways to go about it. It's either you leverage against your residential portfolio, and then you get the residential rates,
Yes.
so cheaper rates, and you use that to fund your commercial acquisition.
Sure.
So you've got slightly cheaper rates on your residential properties and you fund your commercial properties with that.
Yeah.
Or you sell your your residential investment properties, and then with that equity, you reinvest that direct
Sure.
into commercial
and
property.
that's what you've seen a bit of?
Both. Yeah,
Yeah.
absolutely both.
Because I can understand how you could potentially just you top up your mortgage on your residential properties, take the proceeds, go to a commercial lender, and off you go. If you have enough, you have to have quite a bit, because generally you're looking at 30-35% needed.
Yeah, absolutely. But
So commercial property banks will, if you're using the commercial property as the security, so typical mortgage, banks will lend 65% maximum. If the building's empty, they might only lend 50%. So you need more money.
A lot, yeah.
Yeah. So one of the big things with commercial is just the numbers are so much bigger. But not always. I'll talk about a case in a sec. But that's if you're borrowing commercially and you have commercial lending, so you're paying another 2% more than you would be on a residential mortgage. And one of the big things is the risk. The terms are typically 5 years. So you might have a 15-year mortgage, but it gets rolled over every 5 years. So if we end up with another 87 share market crash and the banks get in the shtuck, they might call in the loan at the end of the 5 years. So typically you won't be to sell the buildings because everybody will be wanting to sell, and it's messy. And so if you borrow off your residential portfolio or even your own home, as I have done, it's actually lower risk. You can have 25-year mortgage, so the banks can't call in the loan. Your interest rates are lower, so you're paying the loan down quicker, and it's just it's a really good way to go.
I guess there are barriers to entry in terms of buying commercial property directly, and the main barriers are equity, lending criteria, your own personal circumstances, cash flow, all that sort of stuff, right? The lender's going to look at it quite differently, but if you were not in that position where you had significant levels of equity or other assets that could be leveraged against to buy into commercial, talk to me about some of the other ways. And we've had on the show already, we've had other guests on talking about listed property funds and index funds that comprise of commercial property funds. And that's one way of doing it, where you can gently scale into it. But talk to me about what you guys do, which is kind of unique, which is the Provincia Fund. So tell me about that.
So the Provincia Property Fund, it was set up originally when we had a number of investors that had been through our commercial property masterclass. They were looking for property and they were having a big difficulty finding property to buy. And so 7 of them said that they wanted to form a syndicate, and would we help them do this?
Sure. And a syndicate in this case would be 7 of these people would get together, pool their money together, form a company, and buy a property in the name of that company. Is that right?
Yeah. So we did it a bit differently. We didn't go down the syndication route because syndicates typically own 1 property, maybe 2.
Right.
And it's hard to exit a syndicate. The risks are just a lot higher when you've only got 1 property.
Sure.
They were the impetus for us to set up Provincia Property Fund, and we set it up to be as close as possible to direct ownership of commercial property. So the way it works is the shareholders own Provincia, and Provincia owns the properties.
Sure.
The properties pay a rent to Provincia, and Provincia pays a dividend to the shareholders. So
Right.
it's real simple.
So it's kind of what you would imagine. It's pretty common sense. So Provincia owns the properties, and then shareholders buy shares in Provincia.
Correct.
And is there debt? Like, does Provincia borrow? Is there leverage?
We do. It's conservative borrowing, but we do borrow. So we've got 45% leverage.
Okay.
So any building that we buy, 45% will be funded by the bank and 55% by investors.
Sure.
So the borrowings, because of the low interest rates, the borrowings amplify the returns to investors. But because if you leverage it too highly, it can also amplify the risks quite high. That's why we're conservative on the LVR.
Understood.
So the loan-to-value ratio, 45%.
Got it. Because you want to have a little bit of that spice, right? But not too much.
Yeah. Correct.
And we're getting very
Good way of
good.
putting it.
Yeah, and we're getting very competitive lending from the bank as well, because we're the size of our fund. Currently, the the total value of the fund is 39 million.
Yes.
So 45% gearing on that is quite a substantial amount. The banks take a GSA, General Securities Agreement, across the properties.
Sure.
And so the lending's actually very low.
Sure.
I think our current rate is 3.49%.
Is that right?
Yep.
And as a direct commercial property investor, you can only dream of getting
Exactly.
that. So, what are some of the risks with buying into this fund versus buying into one of the funds that are listed on the NZX, for example?
Yeah. So I guess the biggest difference between buying a listed fund and investing into Provincia would be liquidity. So with a listed fund, you can sell the shares. It's really easy. Put in a sell order, they're gone tomorrow.
Yeah.
In fact, they'll be gone in the next 5 minutes.
Yeah.
The broker will get their commission on it, so it's real easy. The downside is that the share price is driven often by investor sentiment. So the share prices can fluctuate up or down depending on whether investors are getting all giggly and excited about the returns and they want to buy the shares, share price goes up. Or if something happens and they're getting all despondent, share price will go down. With Provincia, the share price is driven by registered valuations on the properties.
Yeah.
And so it's a very rational valuation approach. It's not something where we pluck a number out of the air.
Sure.
It's all registered valuations.
And that lack of liquidity acts like as a bit of a safeguard, right? Because people can't exit right away, and therefore the investor sentiment is checked at the door.
Yeah. Well, there are 5 ways they can exit from the fund. One is it's a wholesale fund, so it's not open to retail investors.
And that's an important thing
Very
to note.
important,
Yeah.
yeah. So our investors, we've only got 46 shareholders at the moment.
Okay.
So it's not a huge number.
So 46 shareholders, and the value of the fund is
39 million.
39 million.
39
Okay.
million.
45% geared.
Yep.
Yeah.
So
Okay.
people have the minimum investment is $50,000, and we've had investors coming in anywhere between $50,000 and $2 million.
Sure.
They're the two extremes.
Okay.
So how can you exit the fund? We've had 3 investors so far who've wanted to cash in some of their investment. None of them have wanted to cash in the lot, and they needed the money for other things. So the first way is you can sell your shares to whoever you want. So although we're a wholesale fund and we can only sell to eligible investors, they can sell to whoever they want. So you could advertise the shares on Trade Me if you wanted to.
Right.
You can sell it to anyone for any price.
Right.
Second way is that they let us know. We will offer the shares to our existing shareholders, and anyone that wants to top up will then acquire those shares at whatever the prevailing share price is.
Which is determined by registered valuations.
Yep,
Right.
correct. So we've had 2 investors who've sold down a portion of their shareholding that have been reimbursed that way. We don't charge brokerage fees for that either, so it's just a service we provide. The third way is that we will offer their shares to people on the wait list. So we only raise money. Shares are only available when we're raising money for a new acquisition.
Right. Are you doing that at the moment?
Yes, we are.
Okay.
Yep. So we've got a building. In fact, Jack will talk about that in a sec if you like, in Carbine Road. What next? The fourth way is that we will treat them as a priority in the next capital raising.
Sure.
So we've had 1 investor who's exited that way. So if we're raising capital for a new acquisition and they want to, for example, sell down by 100 grand, then the first 100 grand that gets raised in that capital raising goes to that investor.
Gotcha.
And it means that the investor who's buying those shares becomes a shareholder immediately,
Right.
rather than having to wait until the acquisition goes through, when it settles and then shares are issued.
Understood.
Yeah.
And so, a couple of things here. So there's lack of liquidity, but that's actually good and bad. Like there's, I'd argue the fact that's probably kind of good.
Yeah. Yeah.
The value isn't driven by sentiment; it's driven by facts.
Yes.
And those facts can be influenced by what we talked about before, by actually getting gnarly on that lease.
Yep.
And getting creative and actually adding value more than just on the building. And then the other important factors to highlight again is this whole eligible investor piece. So, Jack, perhaps do you want to just define what that means to be an eligible investor?
Yep. So we're a wholesale fund, so we're for wholesale investors. What that is under the FMA, Financial Markets Authority, they deem if you invest more than 750. So if you win the lotto and you invest 750, you're deemed a wholesale investor.
Right. You're not necessarily smarter or anything.
No,
you've just got a bit of money.
If you've got that much money, they figure you know what you're doing.
Yeah.
Right. Okay.
Yeah.
Or
So-
you have good parents who
Yeah.
are dead.
Yeah. Exactly. So that's your wholesale.
Yeah.
If you want to invest less than 750, there's a certain set of criteria that you need to meet to be an eligible investor. mainly what we do is we've got a certificate, so we call it an eligible investor certificate, which just needs your accountant, financial advisor or lawyer basically to sign that off, and that verifies to say that you understand the investment product, that you've had experience as in business, employed, understand investments, you've had your own investments yourself. They'll verify that you understand the product, and they'll sign that certificate off. By signing that certificate, that means you are an eligible investor, which allows you to invest in the fund.
Sure.
And we supply that certificate at the back of the investment statements.
Gotcha.
As well.
Okay, so it's like a big kind of, hey, terms and conditions, get this independently verified, because you're going to be playing a game which offers a little less protection to retail investors, or a little less disclosure sometimes.
Yep, absolutely.
So let's actually shed a bit more light on it and make sure that you know what you're doing, because it's not a given that when you do something like this, it's dangerous and it's high risky at all. Sometimes it's the opposite. But it's just not regulated in the same way.
Exactly.
Okay.
Yep. And we send the investment statements to the lawyers, the financial advisors, the accountants as well.
Gotcha. Yeah. Okay, so going back to this fund, because this is interesting to me, because I can see this as, for some people who are listening, this may be a really appropriate first way, a gateway to get into commercial property investment without all of that other stuff. Because they know that the experts are on it, and they know that there is a little bit of leverage, so their gains are going to be amplified. There's smaller chunks to get in, so the barrier to entry isn't as strong.
Much lower.
Much lower. So tell me a bit more about what properties this fund owns.
So our biggest point of difference before we get into the property with our fund as opposed to other unlisted funds is that we focus on value investing. So we're always trying to look for what is the upside in this property.
Sure.
So we're not just looking for a regular property that's got a brand new 6-year lease and it's all fine. We're looking for, okay, well, what can we do to this property in the future that is going to increase both the equity, which is then passed on to our investors via the share price. Share price goes up, they're happy, and also the return.
Sure.
So we're always trying to increase that. We're currently giving a 6% return, but we're always trying to keep that return. So when our original investors invested, we had 7 foundation investors. They invested at $1 for $1, and they were getting a 6% return on that dollar.
Right.
This started in 1st November 2017. Now, to today's date, we're at $1.35. So we've grown that share price by 35%, and investors are still getting 6% on the $1.35.
Wow,
so
that's phenomenal.
Exactly. So those foundation investors are getting 8.1% based on what they originally invested.
Sure.
So our challenge with our fund is what we're trying to do is, as we increase the value of the fund and the share price, we're also trying to keep that return at 6% all the way through.
Gotcha.
Yeah.
So it's taking what happens on the share market and turning it on its head. So on the share market, a dividend would be paid as cents per share. So if it was the same model as us, for example, they might be paying 6 cents per share when people are buying them at $1 a share. If more investors want those shares and they go up to $2, they're still getting 6 cents per share.
Yes.
So your return is halved. You're getting a 3% return on your investment. We've turned that on its head, whereby the 6% that we pay is on the currently prevailing share price. And so whatever the share price goes up to, you're getting 6% of that share price.
That is a massive difference.
Massive. That's why those foundation investors are now getting an 8.1% return on investment.
That's okay.
And I think that's why we don't have a high number of investors wanting to exit the fund.
That could be a clue.
And we have some investors who, every time we buy a building, they buy more shares.
Right. And how are the interests of, thinking about Provincia, how are interests aligned to the investor? Like, I'm thinking, obviously, you want to perform well. You want to create a great fund. But is there any other incentive to motivate you to drive towards that?
There is a performance fee, so that helps. I mean, it's not the driving factor. It helps, but our performance fee is only capped at 13%. So if there's a capital increase above 13%, that's capped. So our performance fee is capped between 8%. So we get anything above 8% increase, we get an additional fee up to 13%.
Got it.
So that helps, but we're also all investors in the fund as well.
Yeah, that's the biggest thing.
That would help the most, I would imagine.
Exactly.
You've got more skin in the game than
absolutely.
some, right?
We've all got our own money invested in the fund. I think nearly everyone on the board and the management and the fund administrator, they've all got investment in the fund itself.
Gotcha. Okay, that's cool. It's a good way to align things.
Yeah.
So we've got this. Just a recap here. So we've got the direct commercial property investment that we could partake in, and there's a couple of different avenues, and there's ways that you could structure that, and depending on your starting point, a couple of different avenues. And then there's the listed property funds, or buying an index, which has that, and then there's syndicates, which we kind of briefly touched on, and then there's this Provincia fund and other unlisted funds, right?
Yeah.
Yeah. You're going to say something, Jay?
Yeah, I was just going to mention about the syndicates. I mean, it is a good way to start as well, but the difference between us and their syndicates is the syndicates are invested in only one or two or several properties, whereas our fund is open-ended, which means as we get more properties into the fund, your risk is spread across more and more properties.
Right.
So even if you're not buying new shares in the future, your current shareholding is being further diversified as we grow the fund.
And so it is kind of like a hybridization of the syndicate model, right?
Yeah, similar. Very similar.
Similar, but it's just a little bit more, well, it's more diversified.
Exactly.
Much more diversified.
Yeah. Touching on the differences between residential property investment and commercial property again. Access to lending, super easy with residential property investment. The barriers to entry, a little bit low, especially if you already own your own home. It's a perfect next step. When it comes to the benefit of residential property investment, like you already touched on before, Brennan, it's kind of like, well, hopefully in the long run, the property values will increase significantly, and that's where my gain is. But on the way there, I'm going to have pretty pathetic returns, and I'm going to have risks, and I'm going to carry all the costs myself. So commercially, take me through how it works with the tenant, because the tenant does a lot more than just pay the lease payments. How does it work there?
So we call it triple net lease, where the tenant will pay for all the outgoings. So they pay for rates, insurance, repairs and maintenance, and management.
Okay, all the things that I'm paying right now as a residential property investor, that I'm suffering, I'm carrying the burden of that. That's all taken care of by the tenant.
Correct.
Wow.
And on the triple net ones, like we've got some buildings in our fund that have triple net leases. So
triple net just means that all those...
take a step further. So the triple net is on top of paying the rent and outgoings, they're paying for the servicing and repair and maintenance of the services that they've got. So we've got a cold store in our property fund. They maintain that the refrigeration unit. So we own it, but the tenant maintains it, looks after it, repairs it.
Gotcha. So the only thing that you're really responsible for is the envelope, right?
Yeah, essentially.
Like if the roof is leaking, that's on you. But with the tightness stuff,
I mean, if it was just normal maintenance, tenant would pay for that. But if the roof needed replacing, we would pay for that.
Sure. Okay. But that kind of just simplifies the heck out of everything, doesn't it? It just kind of turns the whole proposition into cash flow right away.
Yeah, and so that what Brandon touched on before about having the residential and losing 2% margin because you're paying those expenses. Commercial, you're not.
Right.
So you're instantly getting that margin on top,
Okay.
So you're not losing that. So your return in hand of, say, 6% is net instead of gross.
Sure.
If you were a residential investor wanting to get the same return, you'd need an 8% yield to get what a commercial investor would get on a 6% yield.
Understood. And to get that yield, you're going to be buying properties that won't necessarily increase in value very significantly either, because you're going to have to go further out.
Exactly.
In most cases, or take on board some other sort of risk.
Exactly.
So
quite right.
We're in a bit of a, I guess, would you say we're in a bit of a heyday with commercial property investment, with all these people flooding in? And
we sure are.
Yeah?
Yep.
Do you think that it's cyclical? Like, are we going to see some changes, especially in the industrial space? It sounds like that's the safest space to play in. But what are some of the risks? What are some of the things that could happen which could get people unstuck when it comes to commercial property investment?
The biggest one's vacancy risk. That's definitely your biggest risk with commercial property.
Right. What's the worst case?
The worst case is you're stuck holding the building, paying the outgoings with no tenant.
Right.
Because if the tenant's not there, you've still got to cover those outgoings. So as in, your insurance, your rates. Yeah, exactly. So if tenant's not there, that's the worst case scenario.
Okay.
But we're always looking, like I said, on our fund example, that's a bigger scale, but it still works on smaller scales. We're always looking for, okay, what's the vacancy rate in the area?
Yes.
And we're always looking at, okay, if you're going to buy a building, and what can you do should the tenant vacate? So we're trying to look at, if it's just like an industrial building, which is just a shell, you could easily get another tenant in there.
Gotcha.
So that mitigates that factor, but that is definitely the biggest risk.
Okay.
Other risks is, you got tenant risk and but you
Market
can,
risk.
Yeah, and market risk, but market risk is probably a big one. But the market is very buoyant, especially in the industrial market at the moment, and that trend's continuing.
Okay. So, Brandon, before, I've just picked up on the fact that we missed a couple of the steps that you mentioned before of those 5 things. Can you just go back and circle back and tell me about that?
Yep. So the fifth way to exit the fund, or do you want me to recap on the first 4?
Actually, yeah, give me a quick summary of the first 4,
Okay.
and then tell me that 5th one.
Okay, so to exit Provincia, you can sell your shares to anyone you want. We can offer them to existing shareholders who want to top up. We can offer them to shareholders on the wait list waiting to come in. We can prioritise you at the next capital raising. Or the 5th way, which is a work in progress at the moment, we're looking at listing on Syndex. So Syndex trades in unlisted securities, and that will provide additional security. So that's something we're working
and
on
liquidity.
at the moment.
Yep.
Yeah, I've been thinking about I haven't done this, but I've been thinking about actually reaching out to the guys at Syndex to get them on, because that's really interesting. Fractionalization of unlisted assets.
Yeah,
it's quite cool. So that's what you're looking at. Okay.
Yep.
So before we finish up on this, is there anything else that you'd say to everyday investors who are looking to enter into commercial property investment? What would you say to them right now?
The main thing is to upskill, learn.
Right.
Go through the course, learn what you can, and as a result of going through that, you will map out the path that's right for you.
Sure.
And we will help you map out that path. That path might be to do nothing. It might be to invest in a fund. It might be to do a direct investment. Whatever it is, we'll help you map out that strategy. But don't do anything unless you know what you're doing. And to know what you're doing, just learn. Go through the course.
Excellent.
And I think the biggest thing is to take action as well. So on top of learning is to take action. I mean, I wish I had invested in commercial property earlier. I started investing in residential when I was 21. Didn't start investing in commercial until I was 25.
Yeah.
Wish I had invested
All
in
those
commercial at
wasted years.
21.
Yeah, exactly. I bought my first home at that age. That's pretty good.
But that's my advice to any investors even considering it, is to do some more homework, like Brandon has just said, but also take action.
Sure.
And if you got to buy the right investments, but if you can get in sooner, just get in.
Yeah.
Right. That's a constant theme that we keep on hitting is wish I would have started sooner. And also just the most important thing is just make a start.
Yeah.
That's awesome. Yeah. And I know that a lot of people listening would have probably benefit a lot by what you've been talking about. And so thank you again for your time. Really appreciate you guys taking the time out and coming into the studio. What a lot of people don't know is that this is actually our second run. You were in a couple of weeks ago, and I forgot to actually push record. I had the mic turned off. So I appreciate your patience with me, and for coming in again. So thank you again very much, guys.
Thanks.
Thank
Darcy.
you.
Awesome. Cheers.